Well, hello, everyone. I'm Glenn Setchfield, Director of Marketing for DMI. Welcome to our ongoing DMI University webinar series, where we explore agent topics related to sales, marketing, and operations that can make a real difference in your business. So today, we're kicking off our three-part webinar series on fixed indexed annuities. Today, we'll be discussing Athene, what is a FIA, using the index as a measuring stick, alternate indices, and places a FIA can fit various client needs. And then in part two, on November 10th, we'll discuss Athene's very flexible BCA suite of products. And finally, on November 17th, we'll discuss Athene's Protector 5 for the broker-dealer audience. You'll be receiving reminders from us on all of these things. But we're looking forward to getting started here. So be aware that we are going to mute and block participant video during the presentation, but we'll open it up at the end of the 30 to 40-minute presentation for Q&A. Today, we're very lucky to be joined by Alex Hill of Athene and Phil Ferrara, VP of Annuity Sales for DMI. But I'm going to stop talking and hand things off to Phil for a few words.
Thanks, Glenn. DMI Marketing and Athene have had a great partnership for probably close to 15 or 20 years now, and that partnership has worked well for both parties because Athene has always been a pioneer in the indexed annuity market and continues to deliver some of the most competitive indexed annuities in the marketplace. And the reason we have this webinar today is, number one, to talk more about Athene and their competitiveness in the marketplace, but more importantly, why are fixed annuities so popular today and what are some of the uses? And Alex Hill, who's a business development wholesaler for Athene and works with a number of key distribution partners, really manages a lot of what Athene does, from training events and helping educate advisors like us on the benefits of fixed index annuities. Prior to his current role, Alex worked on Athene's inbound sales line, where he assisted producers in case design and pre-sales questions. Alex attended Iowa State University. He holds his Series 6 license. Alex lives in West Des Moines, Iowa, with his fiancée, Ashley. In his spare time, he enjoys time with his nieces and nephews, cooking, boating, and music. So, Alex, we're all looking forward to hearing what you can tell us more about Athene and some of the products they're utilizing, as well as giving us some great case studies. So take it away.
Perfect. Hey, thank you guys for the intro, and thank you for having us. Like you were saying, we are a partner here with you guys, and we really hope to make it that way. And I hope to show you guys how Athene can benefit your clients, how an FIA can benefit your clients, and what we can do. So the first things we're going to do today is let's talk about what we're going to cover. So we're going to go over Athene's story, fixed annuity basics and pricing, using our efficient frontier research within an FIA, and then we're going to cover a couple of case studies to really kind of show the effectiveness of our products and our efficient frontier research. So our story, who is Athene? Well, we are a leading retirement services company that specializes in fixed index annuities. So we only do annuities. We do not do life insurance. We do not do long-term care. We solely do annuities, which really makes us, focus on one thing. It makes it very simple for us. We are positioned in the retirement savings sector for the long term. So we are a relatively young company, being founded in 2009 as a reinsurance company based out of Bermuda. But even through that short tenure, we have been able to acquire multiple companies. And with those companies, we actually have a much longer historical presence in the industry. We are publicly traded, And, we're really focused and committed on the growth of not only our business, but our clients and our customers' funds as well. So let's take a look at something else here. So we have $202 billion in GAAP assets with A ratings across the board with an A+ rating in the S&P. We've actually been running at A+ metrics since 2019, but as everyone may recall, last year was a tough year, and they weren't really sure how the industry was going to react, how everything was going to go. So it was tough for us to get that A+ rating, but we did finally get that from the S&P. We do anticipate those will be coming from AM Best and Fitch as well. So at a glance, Athene has 59,000 appointed professionals. We are the #1 provider in the FIA space, and we have been for the last, I believe, 14 months. We have 100+ years. This is what I was talking about with our acquired companies. We have 100+ years in the industry. 1,300+ employees. Think about this, guys. $202 billion in assets with only 1,300 employees. We are lean and we are mean and we are effective. We're the #2 in the US PRT market and the #4 largest portfolio of fixed deferred annuities. But hey, you guys don't have to take my word for it. We've also, won some solid awards here with the SRP. This is actually a little outdated. We did actually recently win FIA of the year again this year with the Performance Elite, as well as PRT Team of the Year as well. So we are an industry leader. So let's take a look at some of our competitive advantages. The first one I want to touch on is going to be our better asset management. So we did start in 2009 as a reinsurance company, and we were backed by Apollo. And with that, we are actually still partnered with Apollo. I'm not sure if any of you are aware, but we will be doing an official merger with Apollo at the end of the year here. And with that merger and with, Apollo's assistance, we've really been able to, earn and keep our clients' wealth very effectively. We're able to earn roughly 40 basis points higher than the industry average or other competitors in the industry. We also have lower operating costs. Remember what I was saying? 1,300 employees with $202 billion in GAAP assets. That's lean, that's mean. We're doing things quickly, effectively, and we're doing it cost effectively as well. And then thirdly, that tax advantage. So remember I said we were based out of Bermuda as a reinsurance company initially. So that's actually going back to our lower operating costs because we do actually reinsure the vast majority of our own business, as well as we insure a lot of the business of our competitors as well. So why would we do it out of Bermuda? Taxes, obviously. With doing it that way, we have roughly 9% less tax effective rate than our competitors, giving us a tax advantage in the industry. So overall, we're really able to provide consumers with a better value proposition. So let's talk about some fixed annuity basics. What's a fixed annuity and how can it benefit your clients? So we're going to talk about the core benefits, growth, income, and legacy, and then we're going to take a look at liquidity as well. So what's a fixed annuity? It's insurance designed for long-term savings and income and used to manage financial risk because with a fixed index annuity or a fixed annuity, the client's floor is zero. They can never lose a dollar. So we're going to cover today on pricing. We're going to look at the basics using the index as a measuring stick, evolution of indices in the FIA space, and then how Athene prices out our indices. So let's look at the annuity spectrum. At the very bottom there, we have an immediate annuity or a SPIA, and that's going to give the client a payout immediately based on the funds that they put in. And then all the way on the right on the top, we have a variable, it can go up and down. Well, we saw a need, the industry saw a need for something in between the two, a fixed index annuity, where we can offer that higher upside while still maintaining that floor of zero for the client. So it's principal protected, these three, the immediate, the fixed, and the fixed index annuity. Now that fixed index annuity is where we truly specialize. And as I said, principal is guaranteed against loss, so the client can never lose a dollar due to market downturns. So some of the benefits of a fixed annuity are going to be protection, growth, and income. So protection from the market downturns, growth using, either a fixed rate or our FIAs, and then an income, we can also provide income via annuitization or some income riders, which we'll cover a little later today. So the fixed index, the biggest thing here is the growth potential. with those indices on top of the base of the fixed annuity with that downside protection still and the upside potential. So another great thing about an annuity is it is tax deferred. So that means that any interest earned will not be subject to income tax until it's withdrawn. So that means the client is not paying any taxes on any growth year over year, which is another great benefit to the client. But how does a fixed index annuity work? So first thing we're going to do is we're going to look at our underlying index. It can either increase or decrease in value. And if it goes up, well, hey, we're getting the upside of that while still maintaining that floor of 0. But the important thing with a fixed index annuity is it's what you keep that counts. So index annuities are going to be either capped, participation, or spread on them. And we're going to touch on that in just a minute here. But first, what is an index? So an index is a measure of change in a securities market or a basket of securities representing a particular market. So the most common one is going to be the S&P 500. I'm sure most of you are familiar with that. Then another common one is going to be the Dow Jones Industrial Average or the MSCI EF. So those are some common indices, but how do we know which index is best? Well, we don't, and we're actually going to touch on that later as well with our efficient frontier research. But what you can see here is any index in any given year can perform better than another. So let's take a look at index interest crediting. So it's going to be either the index term period, the index change, the crediting method, and then the crediting rate. So the first thing we're going to cover is the term period. Now, most of our indices come in a 1 or 2 year point to point. And what this means is we're going to track it from October 19th, 2021 to October 19th, 2022. And any change is what's going to be credited towards the index growth in that given year. Now, I did say we also offer it in 2 years, so it would be the same from 2021 to 2023. And then there's the crediting methods. You know, cap rates are going to be very common, and then pars and spreads as well. Now, Athene only has caps on our S&P, and that is simply because with the S&P, it's a highly volatile index that can go up and down very drastically. So, like I was saying, the 3 common types of crediting strategies are going to be caps, spreads, and participation rates. Now, as you can see with a cap, in any given year, the highest a client can get is that cap. So if the index returns 4%, the client's going to get 4% in this example. If it returns 8, they'll get 4, and if it returns 12, they'll get 4. Now, if we look at over here on the participation rate, this is where the vast majority of our indices lie, is on that participation rate. You can see if the client has a 90% participation rate and the index goes up 4%, the client's going to see 3.6. But if it goes up beyond that 4%, that's where they can really see the increased value of a participation rate over a cap. So in this scenario where it goes up 8%, you can see the client's credited with 7.2, 12, 10.8, so on and so forth. Now, the great thing with the FIA, like I said, with that floor of 0, it means the client's gains are going to be locked in year over year. So anytime the client receives a credit, that is now where their contract is locked at, unless they were to pull any withdrawals out of the account. So if it goes up 1 year, it's locked. Now you can see here, it goes down. However, the client's funds are still locked in, still safe, and still have that downside protection. Now, like I was saying, the S&P is going to be the bellwether index of the industry. It's going to be a broad-based composite of large cap U.S. companies, and it first appeared in index annuities in 1999. Over 50% of all index annuity crediting strategies are still based on the S&P. So as I said, if you take a look back here in 2011, 63% of all indices available were the S&P 500. And then if you see over here, the all indices on the left there, 0%. Now, the industry has shifted to, FIA hybrid or alternative indices. And what these means is these are indices that we put volatility controls and other functions in there to give the client a better offer. So that's how we're able to use those participation rates versus the caps, which is, again, a better benefit for the client. So why consider alternative indices? Well, one, for diversification. So we can have an equity versus a multi-asset, correlated versus non-correlated, And then they're also going to have different index objectives and strategies, different ways that they're going to move the funds around within the index itself. And again, it's going to create better diversification for the client. On top of that, we're going to be looking at volatility control. So volatility control is going to provide more predictable, more stable returns. And it's also going to allow us to offer those higher participation rates that I was discussing. But how does volatility control work? So let's take a look at this example here. So we have the base index on the very left there. If volatility increases, meaning the market's, crazier, more difficult to predict, then, the base weight of the index increases into cash. And then that way we have it risk controlled. Now, if volatility goes down, we take more of the fund out of cash and put more of it into the index itself, because that way, the volatility is lower. We can, leverage it higher on the other end. So it makes it a little bit more stable. So for us, volatility controls help hedging costs, which makes everything lower and more predictable. We can offer different customer value and then higher FIA upside potential. And then for the client, the upsides are going to be a higher participation rate. Clients now have real choices. So remember, like I was saying, at one point, all the client could get was really the S&P. That was the vast majority of what they were seeing. Now we have multiple different options for multiple different client strategies that they can use. So the long and the short of the volatility control is going to be this. So the light blue or turquoise, whichever you see best, is really going to be a volatility control index. As you can see, it's going to have much more stable, much more steady returns, whereas that light blue is going to be the S&P 500. It's up, it's down, it's more difficult to predict. Now with the volatility control, it's more stable, meaning it's more price effective to for us to purchase those options. It means it's more price effective for the client. So again, we use the index as a measuring stick. We don't actually invest in securities. We use options to hedge the index performance. So here's a couple things to remember on that. So like I said, we do not invest directly in equities. We manage our risk with the options. And very importantly, our profitability does not depend on market performance. So if the market, shoots up, we don't see, that upside because we're hedging against it going up or down. So our profitability is built in. We know exactly what our returns are going to be year over year. The other thing to consider is index interest crediting is made possible by a sophisticated investment strategy. So how do we price our products? Well, we always like to match our assets with our liabilities, meaning if there's a 10-year product, there's a 10-year near rate. And what a near rate is, it's going to be a net investment earned rate. And what that means is over that 10-year period, we have an expectation of this is what we're going to earn over that 10-year period. So we want to match our assets with our liabilities and be able to, really price it out effectively over that same 10-year period. So net, it's going to be our gross return on our bond portfolio, like I was saying. It's going to be the annual cost of the policy, our target spread, that's going to cover administration fees, commission to you, the advisor, minimum contract guarantees, and then our spread or our profit. Looks like this is freezing on me, guys. Sorry about that. Here we go. So if insurers don't buy the underlying index, well, what do we invest in? Well, typically it's going to be bonds, to generate return on invested premium, and then options to hedge or provide those guarantees. So here's how it works. So if we have a 5% net investment yield and a 2% target spread, or what it's going to cost us to use, then that means that we're going to have a 3% options budget. So our options budget is going to be fixed over the life of the surrender charges. So if there's a 3% option budget, it means we have 300 basis points every year for the next 10 years to buy options for our clients. So here's what we do and what we don't know. We do know that in the previous example that a 3% option budget means we have 300 basis points every year for the next 10 years. But more importantly, what we don't know what those options are going to cost year over year. So our goal is always to use our option budgets to deliver the highest possible value to the client. And here's how we do our pricing. So we only use volatility controlled indices with 1 or 2 year time horizon. By using those volatility controlled indices, we're able to keep the options lower, which means we can offer higher participation rates, and it's going to be more stable, less volatile, and we'll be able to more effectively have an idea of what those participation rates will renew at year over year. because everything's going to be a little bit more stable. So this is going to be more beneficial to both the client and to the company. For us, it's more beneficial because it's more stable. We have a better idea. And for the client, it means those participation rates are going to stay high and be a great buy for them. So it's going to be a better, more realistic to the illustration provided, which is always great. And then, products with riders may have better expected persistency as well, because products with riders are going to be tougher to get rid of, which is absolutely great for the client because they're going to be able to have that death benefit or enhanced lifetime income on there as well. So here's the conclusion to our pricing thoughts. So fixed index annuities can really help your Medicare clients. Their alternative indices are a great fit for the index annuity value proposition. The details behind an index are important. It's not just about the highest participation rate, it's how that index is put together. And then innovation in alternative indices can add significant value to policyholders. So fixed index annuities, growth and protection, access to the money for the client, tax deferral, as well as additional features. So the next thing I want to talk about today is going to be the importance of diversification. I said, we don't know how any given index is going to perform in any given year, and we're going to kind of touch on that right now. So if anyone's familiar with the 3 rules of investing, they're going to be very similar to the 3 rules of real estate. So the 3 rules of real estate are going to be location, location, location. And in investing, we think of it as diversification, diversification, diversification. What we don't want to try to do is try to time to market, because nobody has ever been able to effectively do that consistently year over year. What we want to try to do is we want to try and be in the right place over time. It's the best use of your client's money and their time as well. So does anyone know who this is? It's not the grandpa from the Munsters. This is going to be Harry Markowitz. And Harry Markowitz is an American economist who wrote Portfolio Selection in 1952 and created modern portfolio theory. So in 1952, when he came out with modern portfolio theory, his peers, his contemporaries laughed at him. They said, "This is ridiculous. This will never work." Well, he got the last laugh in 1990 when he won a Nobel Prize for economics, and we still use this today. So how does the efficient frontier theory work? It's all about maximizing return per unit of risk. That's the long and the short of it. All we want to do is we want to get the client the highest return for the least amount of risk possible. And we've actually gone out and produced a white paper to demonstrate how to use this within a fixed index annuity. And I can get that out to all of you after this presentation as well. So here's our index lineup. We have, as you can see, the S&P 500, that true bellwether index that I was talking about. And then everything from here on out is going to be all volatility controlled. So we have the S&P 500 volatility control with an 8 or 5% risk control. And what this does is this allows us to track the S&P, but also offer a par rate on top of that for a better value to your client. We also have the AI-powered U.S. Equity Index, an Advanced Equity Exposure Index. The BNP MAD 5 is going to be a multi-asset index. And then the NASDAQ FC, which is going to track the NASDAQ. That's going to be Netflix, Google, Facebook, and so on. So if we look at this calendar chart, again, it's very difficult to know in any given year which index is going to perform the best. If you look at 2009 at the bottom there, the BNP MAD 5 was at the bottom with 2% return. And then it went on a little bit of a run there, 3%, 7%. And then, again, it's at the top 2 years later. So again, we don't know what index is going to perform the best. So what we want to do is we want to diversify out so your clients can have the best use of their funds. So what we did is we had our actuaries go in and actually run 44,000 allocation combinations. And we had it plotted out on a graph here, standard deviation of risk versus return. And what we found is those dark blue dots at the top is going to be our efficient frontier. So that is where the client's going to get the highest return for the least amount of risk. And then what we did is we laid that against our own indices one by one. As you can see, none of them actually fall on that efficient frontier on their own. The 2-year apex was close, but it was a little too risky. So let's take a look at these allocations that we came up with on the efficient frontier that's easy for you to use and it makes your job much easier as the advisor. So we have one for a conservative client, a moderate client, and then a more aggressive client. So if we look at these returns one by one, we have an average, we have a return of, 4 to 5% on the 1-year strategies, and then 5 to just over 7 on the 2-year, with risk going from, almost 25% all over the board there. So what if we plot those out though with our Efficient Frontier strategies? You can see the average return is actually going to be about the same, if not better, than each index on its own, while also having a much lower level of risk for the client. So this is great. This makes you a hero where you have a much less likelihood of having a zero return year in any given year. And you also have these higher opportunities for these higher returns. So Athene is actually so big on diversification that we actually went out and put these in all of our illustrations. You'll find this before you even see the illustration itself. We're really big on diversification and showing the benefits to you and to your client. So a couple things to remember is, again, use the power of zero. That floor of zero. Zero is your hero. Don't try and time the market, and diversify to be in the right places over time, as opposed to trying to be at the right place at the right time. And now what I want to touch on is some case studies here to really kind of show you the benefits of each of our products. So this first one is going to be for immediate income. So let's take a look at the case design facts. We have a client, age 67, with a $300,000 IRA. They're retired, pulling Social Security of about $2,000 a month. The issue is they have $3,000 a month in expenses. So obviously the client's goals is to fill that monthly income gap. And obviously they want to fill it as efficiently as possible. So the traditional way that we would do this is, we would plug this information into our illustration software, solve for the payout that we need. So for $12,000 a year or $1,000 a month, what we would need to invest into our Ascent Pro bonus would be $222,000 at the very beginning. And then we turn on that lifetime income and boom, that's how we calculate for that. But would you consider a more efficient strategy that's going to use less of your client's capital and provide them the same guaranteed lifetime income? Obviously, right? Well, let's take a look at how we could do that. So with the Ascent Pro bonus, income payouts increase every single year. So the payout factors that we use to determine the lifetime income increases every single year, as opposed to every 5 or 10 years with some other products. Now, if your client takes a free partial withdrawal in those first couple of years, then you increase that payout factor by as much as 10% without triggering the lifetime income, and it allows that income base to grow larger. So what we're going to do is we're going to pull out withdrawals for 5 years, and then at that time, we're going to trigger that same lifetime income. So we're going to defer it out and then turn it on. So let's take a look at the same product with a different approach. What's the capital required this way? $201,000 versus that $222,000. That's going to be $20,000 less capital, or roughly 10% less capital. This is a much more efficient way for your clients to use their money. It makes you look like a genius as an advisor, and it makes them trust you more because you're not trying to take all their money. They go, oh man, he really has my back. Look at this. He found a way to do this much more efficiently and much more effectively for me. So let's take a look at this right here. So we pull out those same $12,000 year over year. And then at the end of that 5-year period, that's when we trigger the lifetime income. It's a much more cost-effective way for your client to do business. But what if I told you there's a third option to do this with? Purchase a product that's designed for growth with no fees. It's going to provide an immediate increased death benefit, and it's going to allow your client to grow their benefit base over time and watch the income payout factors increase annually. So what we're going to do is we're going to use that same efficient capital premium of $201,000. We're going to use the aggressive allocation of our Efficient Frontier, take $12,000 free annual withdrawal for the next 8 years. And then at the beginning of year 9, we're going to trigger that lifetime income. So similar to what we did with the last one, well, we're going to defer it out a little bit longer here. So as you can see, we're pulling out that $12,000 year over year. And then with the Agility 7, when you trigger that lifetime income, the client's going to have almost $14,000 of income versus that 12. Again, it makes you look like a hero. You can offer your client a higher income at the end of that period. But what if you say, well, 4.73%, that seems high. I don't know if we're really going to hit that year over year. Okay, fair enough. Well, what if we drop it to 3.5%? We cut out, a point and a quarter off the returns. Even doing that with an assumed rate of 3.5%, which is right in the zone where we want to be for an annuity, we're really looking for a 3 to 5% return, then we can still assume the client's going to have that same payout year over year, and they're not going to see a loss of income. They're actually going to see a rise of income afterwards. So here's another option. Use the Agility 10. We're going to use the same efficient premium, and then we're going to allocate it onto the efficient frontier. Trigger lifetime at the beginning of year 11. We're going to offer the client $15,000. And with just an average return of 3.8%, we can still offer the client that same floor of $12,000 annually. But what if we use the initial premium of $220,000? Again, use that same aggressive allocation on the efficient frontier, pull out the $12,000 free withdrawal for the next 10 years, and then trigger the lifetime income at year 11. By doing that, the client's going to have $17,000, and we're only going to require 2.67% return to meet the bare minimum of $12,000. So again, you can give the client a much higher income with very little return required. It's a great solution for your clients. It's a great way to, again, make you look like a hero to your clients. So we have three different options for immediate income. We have the Ascent Pro 10 bonus, the guaranteed level income, the traditional way to do it. The Ascent Pro 10 bonus using the capital effective, the efficient way to do it, and then the Agility 7 or 10. And while we're talking about the Agility 7 or 10, that's actually going to be the next product I want to discuss with you guys, because how many of you have clients who don't really know what they want? Well, this may be the exact product that they need. So let's take a look at the designs of this one. We have a client who's age 50. They've recently changed jobs, and their 401k is available for rollover. They have $100,000 in assets and their goals. They're undecided if they're going to need income or not. If they would, it'll be at age 67. But really, they'd prefer to only pull out those RMDs, only have to pull out what they have to. Interested in leaving a legacy for their kids. Concerned about being a burden to their kids. Looking for protection against market loss with upside potential. Bottom line is the client needs a flexible solution. Now, does this client scenario sound familiar? Can I have everything, please? Can I have it all? I want income. I want death benefit. I want everything. Well, we have the solution for that in the Agility 10. So we're going to take that $100,000 or a portion of the 401k rollover, and we're going to move it into the Agility 10. The Agility 10, a flexible FIA contract that's going to provide a free income and death benefit rider, earnings indexed income for life, death benefit available from day one, and a lifetime income doubler for confinement. It's going to double your client's income when they need it the most. And then obviously diversified index selections vetted on our efficient frontier. And remember, with all FIAs, zero is your hero, and this is going to be a flexible fixed index solution for your client. So let's take a look at this right here. We put that $100,000 into the Agility 10, use that aggressive allocation on the efficient frontier. It's going to average us a 5.28% of return based off the most recent 10-year period. So let's take a look at option one, where it turns out the client does need that lifetime income at age 67. So we have the earnings index income triggered at age 67. Annual lifetime income at age 67 is going to be $17,000, and then it's going to increase year over year. So the great thing with this earnings indexed income is it's going to increase by the exact same rate that the accumulated value is credited to. So if there's a 5% credit to the accumulated value, that lifetime income is going to go up by 5%. It's a great way to offer a cost of living adjustment for your clients, and it's a really great benefit to them. So if we pull that lifetime income through, the client's expected age of age 85, the client will have pulled out $44,000 at age 85 as his lifetime income, and then a cumulative of $526,000 of lifetime income. But hey, let's say the client's only going to take RMDs. Turns out they did a little bit better than they thought. They don't actually need that lifetime income. They're only going to pull those RMDs or required minimum distributions because the government says they have to. So let's take a look at how that's going to look. So at age 72, when the RMDs begin, the client's going to pull out $12,000 that first year. The death benefit is going to be available immediately if needed, or the lifetime income is going to be available after the 10th contract year, again, if needed. But we pull RMDs to the client's life expectancy age of age 85, $209,000 in RMDs through age 85, and then the client passes at age 85. There's a $515,000 death benefit that can be paid out over the course of a 5-year period. So again, this is a great benefit for your client who, they really want to be able to leave on a legacy for their kids. With this benefit base, it's going to grow to 175% crediting. It means it's going to grow at a much more quick rate than that accumulated value, making it a great play for those clients who want to leave on a legacy to their family. But let's take a look at option 3, where the client, again, they're only pulling the RMDs, but it turns out they need confined care down the road. So what happens if, life happens? The client goes into a nursing home at age 80. Well, at age 80, what we do is we trigger that lifetime income with the doubler. And so what that's going to do is the client's going to get that $35,000 lifetime income, and they're also going to get the enhanced income benefit of, again, $35,000. So it's going to double their lifetime income, meaning they don't have to be a burden to their family. They'll be able to pay for that, care facility on their own and not to burden their family with it. And after that lifetime income doubler runs out, the AV goes to 0, the client's lifetime income will still continue to pay out year over year. So if they do make it through the storm, they still have, that 43,000, 47, so on and so forth to fall back on. So let's take a look at this case study here. No matter what your goals are, the Agility is a great and flexible solution. Your client can control when and if they need the benefits of the policy. It's going to provide growth with protection, diversified index selections, index earnings income that's going to, be that great cost of living adjustment, lifetime income doubles for confinement, and that death benefit rider. But most importantly, it's going to offer flexibility to your client where they can really grow into the product as they get older. So be sure to use the Agility 10 for all or part of your client's 401k rollovers. And then the next thing I want to talk about today is our AccuMax 7. So our AccuMax 7 is going to be an accumulation product that's going to have a 7-year point-to-point, and I'm going to tell you why that's going to be a great thing. So in this scenario, we have a client age 55 with a $350,000 IRA. Client's goals, obviously to maximize growth, which we're able to do with the AccuMax, and then they want to convert their IRA into a Roth IRA. So when they pull funds from it later on down the road, the taxes are tax-free at that point because they've already paid them off early. So, but what we really want to do is we want to minimize the taxes to be paid on the conversion because obviously the less we can pay in taxes, the better for all parties involved. So here's our solution. It's the AccuMax 7 using our 7-year point-to-point strategies. No earnings are going to be credited on the policy until the end of the 7th year using the 7-year point-to-points. So what that means is we're going to be able to convert these funds while only converting on the initial premium. We're not going to have to convert any initial gains at that time. So let's take a look here. $350,000 into the AccuMax 7. And as you can see, we're going to convert year over year, $50,000 a year over that 7-year period. And then at the end of that 7-year period, that's when our crediting is going to hit. The client's funds are going to jump from, in this scenario, $350,000 to $645,000. So this is a great way for your client to grow and accumulate wealth while also, paying the least amount on taxes for that Roth conversion. So we want to maximize the long-term growth opportunity, minimize the Roth conversion liability, and then we want to set it and forget it with those 7-year strategies. And one thing I didn't touch on with the AccuMax 7 is a guaranteed sale every 7 years. So if we take a look right here at the end of that 7-year period, you can see that it actually goes into a fixed account. So that means the client's funds are just earning, 0.25% year over year, which means it's a great opportunity for you to, again, move them and, again, get paid on those funds. So does anyone have any questions for me at this time?
Hey, Alex, before we ask for questions, I'd just like to thank you very much for that presentation. And I like that Athene and yourself are putting the customer first. So, I think we do have some questions. I'll hand this over to Courtney Tosoni.